Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy. Good morning, everybody. Welcome to our first webinar of 2023. And it's already been quite an interesting period over the first week of 2023. So we'll walk you through how much that may have altered opinions with regard to interest rates, foreign exchange markets, the economic outlook. And over the next 30 minutes, we hope to inform you, if not surprise you, with some of the views that we've got with regard to foreign exchange markets. So without droning on, I'm going to dive straight into the presentation. We're going to look first at how things ended in 2022. Then we'll look at the interest rate outlook and also some of the interesting developments as far as inflation is concerned, before turning my attention to the FX markets and what the latest forecasts look like. And then finally, some high-level thoughts for 2023 and potentially beyond. There's then a disclaimer, and I'll hand over to Piers, who'll provide his thoughts on FX markets. So how did we end 2022? Well, this slide suggests that there was some sign from central banks in December that the pace of monetary tightening was beginning to slow. So all of them who had done 75 basis points back at their previous meetings only hiked interest rates by a further 0.5% in December. But there was a surprise, not from the UK, the US, or Euroland, but from the Bank of Japan, where they unexpectedly relaxed their yield control policy. So that suggests that they're moving to a more hawkish shift on monetary policy as well. And that, along with the significant intervention that we saw in currency markets from the BOJ in the fourth quarter, has helped to stop the bloodletting as far as the Japanese yen is concerned. So the yen is a lot stronger than it was as we entered the fourth quarter. We saw from the People's Bank of China that they reduced their reserve requirement ratio. That's another monetary loosening from them. But they've also relaxed their zero COVID policies. So there is some unlocking of the Chinese economy expected in 2023. And that was another surprise and came after numerous protests in big cities around China. There was also quite a sizable fall in inflation readings, although these were more pronounced in the likes of the US and Eurozone than they were in the UK. So the UK is now lagging behind, materially behind what we're seeing in the US and the Eurozone, and potentially will continue to do so in the early stages of 2023. And there were further signs of a contraction in the UK, but some surprisingly positive readings from the US and Euroland GDP figures. From a geopolitical perspective, there were no real signs of any concerted efforts to try and resolve the Russia-Ukraine conflict and get a peace accord in place. And although there was a suggestion from the Russians that they were going to agree to a ceasefire over the Orthodox Christmas period, in fact, there was no end to the fighting over that ceasefire. So I do think that there are still a number of problems as far as getting any sort of resolution to Russia's invasion of Ukraine, because neither side, I think, seems to be willing to give any ground in terms of negotiations. Russia won't look to give back the territory that it has managed to win, and Ukraine is still trying to push its counteroffensive against Russia to push Russian troops out of Ukrainian territory. So whilst 2022 ended on a low note in terms of geopolitics, there was greater optimism as far as some of the macroeconomic data. And I think markets definitely took that to mean that the peaks in UK, US, and European interest rates might be lower than they'd previously predicted. But if we go on to the next slide, I think that what we need to look at here is that there is the potential for some surprises in both directions as far as interest rates are concerned. So from the US's perspective, we might actually see interest rates rise to a higher peak than the market is implying and stay there for longer than markets are implying as well. A lot of the commentary that we've seen from the Federal Reserve members recently has hinted that rates have to rise to at least 5%, if not higher, and then stay there for a considerable period of time, potentially until the end of 2023, if not longer. Whereas from the Bank of England's perspective, I think it's a much more mixed picture that we're seeing from officials there. So whilst they're still concerned about inflation, they're getting more concerned about the potential for a persistent and sizable downturn in economic activity, which means that they might cut off the interest rate hikes before we get to where the market is currently implying interest rates to be, and peaking at around sort of 4.5–4.75% is still where the UK is seen to be as far as interest rates are concerned. From a market perspective, we think the peak will be lower than that, but there won't be any rate cuts coming until 2024 at the earliest. For the European Central Bank, the refinancing rate is likely to peak marginally lower than the market implied forecast, which is coming in at around 3.75%. I don't think that there's a significant risk of materially higher than that, because that would be another 125 basis points on top of where interest rates are now. So they would be the central bank that hikes by the most this year. And that could have some ramifications for currency markets as we head through 2023. That closing of the interest rate differential between Europe and the UK and also the US, I think could potentially be beneficial to the euro. Moving on to the next slide, and this is the where inflation is, and the encouraging thing here is that ongoing push lower as far as headline inflation is concerned for both the US and the Eurozone, and some tentative signs that UK inflation may have peaked, albeit that we are going to see less support in terms of the energy price hikes for industry, and that could push prices up in the early stages of 2023. Equally as well, there is still a hangover effect of higher energy prices on things like food price inflation. So we might not see food price inflation peaking until later into 2023, potentially after the close of the first half of the year. The other thing to note, though, is that average earnings growth predominantly across these major economies is not following inflation higher. So average earnings growth is still capped at around sort of 5–5.5% for most of these economies. So materially under where the current headline inflation rates are. So that could, in the short term at least, prompt some significant additional pullback in these inflation rates beyond what's expected by the central banks. In the longer term, though, I think there is a fear that inflation might prove stickier, and wage inflation in particular might play catch up over a multiple year period. So when inflation rates fall back to much closer to target, average earnings and wage inflation rates might be higher for a longer period, the next sort of 2 to 3 years, and therefore might exceed where the headline rates of inflation are. Moving on to the next slide and taking a look at the currency market forecasts. These have changed again, so it's worthwhile just noting that we're a bit more optimistic about the prospects for sterling against the US dollar and also euro dollar, so constructive over 2023 and into 2024 for both of those currencies. It is a dollar-based move, though, because if we look at other currencies against the US dollar, you will see additional signs of strength here as well. So for the likes of the Japanese yen and the Swiss franc and the Australian dollar and the Chinese renminbi, et cetera, we're expecting there to be some additional downside risks as far as the dollar is concerned, so upside risks for the currencies against the dollar. That said, I do think that we need to be somewhat wary of trying to overinterpret what we've seen in the back end of 2022 and in the early stages of 2023. I think there is still a risk that the most recent improvement in risk appetite that we've seen, which predominantly has come because of the lower interest rate expectations in the US, according to the markets, that might be completely blown out of the water if the Federal Reserve continued to tighten well beyond where the market sees the peak in US interest rates. And that could create conditions that are supportive for a more sizable and sustained US dollar rally over the course of the next sort of 6 months or so. So I think there are downside risks to the near-term outlook as far as the dollar as far as currencies against the dollar are concerned. So watch out for some concerted dollar strength there. China as well, we've seen a material change to the outlook for the Chinese economy because of that unlocking, that COVID unlocking that we've seen. And that will persist over the course of 2023. So we could see sustained strength in the Chinese renminbi, whereas previously we had been suggesting that there was the potential for the Chinese renminbi to underperform not only the major currencies, but also a lot of emerging market currencies. So if I move on to my final slide before the disclaimer, and this is just some high-level thoughts with regard to 2023 and potentially beyond. There's clearly a growth challenge as far as all of the major economies are concerned, and that will only intensify the higher that interest rates go. So that is one thing that I think could prove to be a problem as far as currency markets are concerned. And the other thing is, how long will labour markets remain as robust as they are, given that there is weakness coming from the likes of the retail sector, services, particularly heavy employers of labour are going to find themselves in a far more challenging set of circumstances because of higher energy prices and all. And also the issue with regard to the problems around, as we've seen some of the manufacturers saying, that the energy price challenge that they're facing might mean that they have to make reductions in their labour forces. So I think labour markets will look significantly less robust into the second half of 2023. As far as the US dollar is concerned, well, you know, that we've still got to show the dollar in the light of where it was at the beginning of 2022. It's still significantly above those levels against all of the major currencies. So the uptrend, as far as I'm concerned, is still intact for now, and it can give back additional amounts of the gains that it made over the course of 2022 without arresting that uptrend. But we need to keep a close eye on it. And I'm sure Piers will make reference to this in his presentation. The energy markets as well, I think there's still a substantial amount of volatility in here, but energy prices are on a definite downtrend. But if we were to get a cold snap, which was to eat into the levels of gas storage across the UK and Europe, that then could put renewed upward pressure on energy prices. So don't think that the downtrend is just going to persist, and don't think that the warm weather is just going to persist either, because we could see some sizable and lengthy cold snaps as we continue to go through this winter period. And then finally, inflation does look to be on the downturn. It's food price inflation that may act as a significant block to additional declines, but that should be eradicated by the middle of the year. So by the time that we turn into the second half of 2023, I think we should have a materially improving inflation outlook across all of the major economies. And the question then is when will interest rates start to fall for the UK, Europe, and also the US? So the final slide is my disclaimer. We won't dwell too long on that. And I will now hand over to Piers, and he'll give you an update with regard to the technical outlook. Piers, over to you.
Thanks very much, Neil. I found that very interesting as ever. I think one thing I found interesting is that the cable forecasts come up. I know the end of last year, you had 109 as for sort of target for the end of the year, cable, and 97 for euro dollar. And now I see those forecasts very flat during the year. So 122, I think you had starting now, going to 127 as a high in the last quarter. So just a 5 cent range really there. I know they're only end of quarter ranges, but And euro dollar was only 4 cents, 107 to 111. So very tight ranges. And I think it's not going to be a dramatic year as last year. And I agree with you, that the market is doing some sort of pullback. But I do think it will be interesting to see whether those have just been pulled up, because that's basically where spot now is 122 and euro dollar 107. But I found that the most interesting part of your conversation. But here we go to my first slide. There's my face. But this slide, yeah, that's the one. So on this one, on this chart, I'm just trying to show the downtrend on the dollar index. So we have here the points 1 and 2, and then it comes down to the 3 and 4, and it broke through that trend line in the big red circle and broke higher very violently. So we go to the next slide. I'm going to zoom into that last bit of the price action. This is where the price actually broke through the trend line. You can see that clearer. Then we got that inside session, and this is the point I was saying, the end of last year, when I know that economic forecasts were sort of different from the chart view. This is why I changed my view and said the dollar was about to change. You got an inside session and price collapsed after that. So you're coming back down, but we could see a bit of a move lower into this 99.101 area. But I think that what you're going to find is as price gets down there, the dollar buyers are going to start coming back in. That's where they should come back in. It's the 38.2% retracement of that move. It's the trend line. It's the Ichimoku cloud. So you've had this big sell-off, and I think that's going to be maybe a bit more of a sell-off, but I think this is where it starts, risk-reward starts to change. But if we go to the next slide, we're going to start looking at the currencies, euro dollar. So I'm going to just start with a nice simple chart on euro dollar, and these are just trend lines. So very simple chart. We have the line, the black line is going back from the creation of the euro 2000, and that has quite a few touches going through. Now, someone at the bank once did tell me, that trend line's too long, but it worked quite well. And when it broke that last year was the start of the collapse down of euro dollar. We can then put on the shorter term chart, the pink line. Sorry, keep on that last chart. Yeah, the shorter term is the pink line underneath. And so those areas, as price gets back up there, we should start to see some resistance come in the sort of 109, 112 area. Within there, you should see some trend line resistance from the rule of polarity, where support and resistance switch around. So it was support, it should become resistance. But now we go to the next slide. Thank you. So here we go. This is the move down I was talking about, this large move down. You then got in October that inside session, which I highlighted on the November webinar. And I said, look for a move higher in euro dollar. And I had this 106, 107.70 as a sort of extreme move for last year. And it's exactly, if you look at it, what stopped it last year. And it's where it's stalling just at this moment. Now, there's a couple of reasons for this big move back up. It'd been a huge move down during the year. And this was why I was quite happy with that call, even though, the strategy team were like, it's 109, at 0.97 they thought would be where it be. I was quite happy that we're going higher, because it's been a huge move. You've gone from 115 nearly to 0.97 that year. Now, there's going to be people who want to take profit before the year end, and you don't want to leave that right into December. So I think that inside session was the first sign of people taking profit. And then it snowballs and more people came in and you got that big move up. And then, yes, you had people talk about change of the Fed. But I think that move had started before that. People were wanting to take profit. And then as it went up and up, people took their profit and it just snowballed the effect. But now you're at a sort of key resistance area. And you might go up to this sort of 108, 109 area. Maybe at a push towards 110, 111. But I think, thinking of the dollar index, once it starts to get up there, you could see a bit of a pullback down. So to start with, I sort of agree with maybe their tight range that they gave on the other forecast for euro dollar. Maybe we are going to go up towards but I think it might be quicker than you think. If you're going to get that test higher, I think it comes in the first or second quarter, and then things start to change. Now, one thing I would like to put on here, but we just didn't have time this webinar, I'll do on the next webinar, is the outlook for the year. Because I just wanted to finish off, last year and the moves and everything. But I think there's going to be a couple of really key stages in this year for the dollar. And that will just reflect through onto all the currency markets. But we'll cover that next time. So in the short term, supports should be in the 103 area on the pullbacks. And I think below 10050 is where the market's suddenly saying, actually, we're going to go for the downside again, with the resistance up in that 110, 109, maybe 112 area. But if we go next slide, we go to the sterling index. Yes, sterling index. Now, this is a very important slide, I think, because it really has dominated what's happening with sterling since Brexit. Well, before that, the crash, the fall started the year before Brexit, and it just exaggerated the end bit, Brexit. But look how much it's recouped. Nothing really. It's never really managed to get a hold above the 38.2 retracement. And I take these retracements off the month after the 2016 flash crash. That was just very thin markets in Asia, trying to do something, no liquidity. So we go to the next month because we know that worked well. The Liz Truss flash crash, I ignore because that was again in Asia, very quickly down, but that came back up much more quickly if you look at that compared to the price action in 2016-17. But on the next slide, you're going to see where I think the line you need to watch is. So the line for sterling to watch is this blue dashed line. So if we just take the good price action, you can draw that trend line up. Now then, if price breaks below that, that's where you have to sort of start to worry if you need sterling stronger. If you want sterling weaker, that's where you start to rejoice. But if you get a monthly close below that dashed blue line, then something's going wrong. On the top side, we still have that 38.2%. And it really hasn't capitalized on that big spike that it had the other month. It's just flatlined. So unless sterling index can get above that 38.2, it's not that positive. But it's just sort of sideways till it breaks out of either that dashed trend line or the 38.2%. And next time we do these, I'll look at the yearly one, because the yearly sterling index is very interesting, and the quarterly sterling index, because they have some very big plays, I think, coming along. So on the next slide we go to is sterling dollar. Now, sterling dollar, these are the same sterling dollar chart lines on the chart from November, where again, I had a very different view to the strategists who had that 109 as their sort of predicted end year rate. I said that inside session, we should see a move back up. I had the 122, 123, 60 area. And why did I choose that area? I chose that area because look at the circles on the left of the chart. There's 1, 2, 3 of them. Support, it's always where the market found support. So it's where you should expect the market to go to. There's going to be a good rally. And again, just like euro dollar, you think last year, sterling dollar near the beginning of the year was 137.50, and it went to 103, 104 during the year. So if you were a trader and you'd sold it up there and you get to October and you're sort of thinking, I have to sort of close up my books. I don't want to lose any profit over November, December. You just start to take your profit there. And again, I think that's why it went back up. And where did it go? It went like a magnet back up to those old lows. So that, if we go to the next slide, actually, I've zoomed in a bit. So this is zoomed in at the end. Look how price action has been last month and this month. It's still sitting just below that 122, 123.60. It tried getting above it last month, failed, came back and closed below it. It spiked lower this month and going back up, testing at it. So it's going to be very important to see how that plays out this month. If you get a monthly close above 123.60, then that would open up 125.87 and 127.50.60 as the next resistance areas to watch. While support on the monthly chart should be 118.50, 119.50 area. So that should be the support. Now, where do you start to panic on sterling dollar? Just looking at the monthly chart, I'd say if it got below 116.25.50, that sort of area, then you start to panic. I put 116.45 as the line on there because it's sort of mid that range. But next time I'll put the yearly cable on, and I'll just put the yearly because then we'll have the quarterly coming not long after that, because that has some very interesting pictures. But, I'm nearly out of time as it is now. I've only got 3 minutes, so we'll rush to the next slide, which is euro sterling. So now do that magic trick of talking both sterling euro and euro sterling. So euro sterling, I had this sort of range to watch 85 to 88.95, and look how that has held since I sort of first said that 3 quarters ago. We've tested up to the 88.95 already this quarter, this year. So in the first place, I'd watch 87.47 as a pivot and say, look, it needs to get back below there. Otherwise, the risk is it goes back up higher and takes out this 88.95. So it's just worth keeping an eye on that. And on the next slide, I put on just these lines. I like these lines. They've contained most of the price action all the way through. So again, you'll see that 87.95 here is the sort of mid pivot here. And it's really important, this 87 area, to see how does that play out. Because if that 87.47 and 87.95, we see it clear that, it could go up towards 0.92. But we're coming back down to test it at the moment, so maybe we're just going to stay in the range. But these are the lines just to watch. And if we go down to the next slide, here it is on sterling euro for you. So sterling euro, the levels I gave were 112.40 and 117.65. I gave that quite some time ago on these webinars, and it seems to have held quite a few quarters. So just keep watching them. Here, the line, the blue line, 114.25 is the pivot to use on sterling euro. And if you get if it starts to get above 114.25, then things might be changing here. But if it breaks below that 112.40, not so good for sterling euro. And the final slide is the same lines I just showed on euro sterling, but reversed into sterling euro. You have 113.70 as a sort of pivot, 119.80, 121 caps the moves at the moment, 108.55 is the sort of base that's held it every time since 2017. But as I say, again, on that one, we can look at the yearly chart next time, because I think these things might be changing, But actually, I told a lie. That wasn't the last slide, because the one Neil always likes me to say is the next slide. The disclaimer. So everything I've said might not be right.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.